or their audit procedures. Then finally, the last category of assertions would be assertions about presentations and disclosure. And here we have management's making representations about occurrence and rights and obligations, and you see a theme here, right, in terms of assertions, right? Are the disclosed events and transactions that the events and transactions that they're disclosing, did they actually occur? And do they pertain to the entity? Is it complete? Have we accounted for have all disclosures been included in the financial statements, right? So GAAP gives us, when you look at generally accepted accounting principles, there's some items that require disclosure, right? You have to disclose the accounting policies or summary of key accounting policies. You have to disclose information about, depreciation, or you have to disclose information about, fair value, for example. If you're involved in, if the company has significant fair value transactions, there are disclosures under FAS 157 that tells a company how you have to report those transactions, right? You have level 1, level 2, level 3. Right? They're required disclosures under GAAP, depending on the transactions that the company engage in. And so what you're looking for as the auditor is that the client has followed that, that they've adhered to GAAP, and they've disclosed those items that are required to be disclosed. Accuracy and valuation, that the financial and other information are disclosed properly and at appropriate amounts. And then finally, classification and understandability is what you have to remember, right? The point in having generally accepted accounting principles is that you create this framework so that companies abide by this framework. You don't have companies reporting under various frameworks. They report under GAAP, right? And because they're reporting under GAAP, that creates this some level of transparency. It creates a format that you can pick up as a user of the financial statements and see that there's comparability across companies, right? A cash means cash. Accounts receivable means accounts receivable regardless of the company, right? And that the disclosures are important to help to explain those items that are recorded in the financial statement. So you want to make sure that management is asserting that, yes, we follow GAAP, we've classified our assets, our liabilities, and owner's equity in accordance with GAAP, we've disclosed in accordance with GAAP, so that the information is properly presented, in accordance with generally accepted accounting principles. So for example, with classification and understandability, if we're looking at the sales and collection cycle, the auditor would look to say, for example, accounts receivable are properly classified as short-term, right? Because GAAP says accounts receivable are short-term. Unless there's some other type of agreement that you have with a customer, you expect to collect your accounts receivable within a year time frame, right? In fact, you expect to collect them in a 30-day time frame. Rarely you're going to have accounts receivable that extend past a year, right? So auditors are going to look to ensure that it's been classified properly as a short-term accounts receivable, and any disclosures pertaining to accounts receivable have been properly disclosed in the financial statements. Okay. Any questions before we move past?